In 2019, a mid-sized logistics company in Ohio commissioned what they thought would be a routine external audit. The auditors finished in 3 weeks. What they found took 3 years to fully prosecute. Their CFO, a 14-year employee, trusted with full signatory authority over company accounts, had been systematically redirecting funds since 2015. Not through a single dramatic transfer. Not through anything that would flag a basic reconciliation. Through 847 individual transactions. Each one small, enough to look like an operating expense. Total removed, $3.8 million. This is a breakdown of exactly how it happened. And more importantly, what the paper trail shows. Understand this that case. Nobody was. You need to understand the position first. A CFO, Chief Financial Officer, typically holds the highest level of financial authority inside a private company. In most small to mid-sized businesses, that means signature, authority on accounts, oversight of accounts, payable, and in many cases, direct control over the reconciliation process that would catch irregularities. That last part is important. We will come back to it. The company in this case, which we will call Meridian Logistics for purposes of this video, operated across 4 states, had 180 employees, and generated approximately $22 million in annual revenue. By all external measures, they were stable, profitable, growing. Their CFO had been with them since 2005, promoted twice, received a performance bonus. In 2014, the year before the scheme began, the question prosecutors would later ask in court was not whether he was trusted. He clearly was. The question was, what structural conditions allowed that trust to go unverified? Had 3 components. Each one was simple. Together, they were nearly invisible. Component 1. Vendor fabrication. He created 3 shell vendor accounts in the company's accounts payable system. Each had a legitimate-looking business name, a real-sounding tax ID, and a bank account he controlled through a separate LLC registered in a different state. Over 4 years, he issued 312 payments to these vendors. Average payment, $4,200. Nothing that would require board approval. Nothing that would trigger a secondary authorization requirement. The total from vendor fabrication alone, $1.31 million. Component 2. Expense reimbursement. Inflation. As CFO, he approved his own expense reimbursements. Company policy required a second signature for reimbursements above $5,000. He's never crossed that threshold on paper. What the audit found was a pattern of $4,800 to $4,950 reimbursements submitted at irregular intervals, never consecutive months, never predictable enough to pattern match on a surface review. Total from expense inflation, $890,000. Component 3. Payroll ghost entries. This was the most technically sophisticated component. He added to part-time contractor positions to the payroll system positions that appeared in the HR software but were never connected to actual onboarding records. The payments routed to accounts he controlled because the amounts matched what legitimate part-time contractors would earn, and because he controlled the reconciliation reports that went to ownership. The entries survived 4 annual internal reviews. Total from ghost payroll, $1.6 million. Combined, across 847 transactions over 49 months. Here's what the 3.8 report identified as the structural failure, and this is the part that matters regardless of whether you have ever encountered fraud directly. 3 conditions existed simultaneously at Meridian Logistics that made this scheme possible. Condition 1. No segregation of duties. The CFO controlled both the initiation of payments and the reconciliation of those payments. In accounting terms, this is called a segregation of duties failure. The person who can create a transaction should never be the same person who confirms it completed correctly. In a company with 180 employees and $22 million in revenue, this is not unusual. Most companies at this size have not formalized that separation. That gap is where schemes like this live. Condition 2. Threshold-based approval. Architecture. When approval thresholds are fixed and known internally, they become a roadmap for fraud. Every transaction in this case was engineered to sit below the trigger point. The solution is not just raising the threshold, it is adding random sample review requirements that make threshold gaming ineffective. Condition 3. Self-reported reconciliation. The reports that went to the board and ownership were prepared by the same person. They were meant to audit without an independent reconciliation, either by an external bookkeeper or a second internal party with no payment authority. There was no cross-check. The auditors who eventually uncovered this were not looking for fraud specifically. They were commissioned for a routine financial review ahead of a potential acquisition. They found it because they pulled raw bank statements and matched them against the accounts payable ledger independently, something that had never convicted on 14 counts of wire fraud and 1 count of money laundering. Sentenced to 6 years federal. Ordered to pay full restitution. The company did not complete the acquisition. The buyer withdrew when the audit results became public. Meridian Logistics was sold 18 months later at a significant discount to a competitor. The legal mechanism that prosecuted this case was Federal Wire Fraud Statute Title 18, United States Code, Section 1343, which applies anytime electronic communications or transfers are used to execute a fraudulent scheme. Each electronic transfer counted as a separate count. That is why there were 14 charges, not 1. The restitution order was for the full $3.8 million. Collections against it are ongoing. What this case illustrates and what makes it instructive rather than exceptional is that the fraud itself required no special access, no hacking, no external conspiracy. It required one person, trusted authority, and the absence of a second set of eyes. That is not a rare combination inside growing businesses. The report from this case runs 84 pages. The 3 structural failures identified in it appear in nearly identical form in the majority of occupational fraud cases documented by the Association of Certified Fraud Examiners annually. If you want to understand the legal framework behind why these charges work the way they do, specifically how federal wire fraud is structured and what prosecutors have to prove, that breakdown is in the next video. This is verdict paper. Every collapse has a paper trail.